Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for June 24, episode 345. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy. Special guest today, Dustin Jalbert, is from Fast Markets. Dustin, great to have you back again.
Thanks, Dean. Thanks, Chad. It's good to be here again and be able to talk some residential construction.
Yeah. Chad, you've been in vacation. How was it?
Yeah, a couple of weeks away. It's been really nice. We spent some time in the North Carolina mountains near where Ben, who's backstage with us, lives. So it was really nice. Yeah.
Was it anywhere near where the horrific flooding was last year?
Yeah, it was. We saw some of the effects, but where we were, and we did have a couple events that got canceled because of that we normally do on some of the rivers where there was a lot of destruction. So yeah, okay. Looks like they're still going through some rebuilding there.
Yeah. All right, good. Great to have you back. Dustin, we've got a lot to talk about when we bring you back on. For those that don't know Fast Markets, and you in particular, tell us a little bit about what you do and what Fast Markets does.
Yeah, sure. So I work as a business economist for Fast Markets, and my specialty is really the North American softwood lumber market. I've been covering that space as a business economist for, I guess, over 10 years now. I can say over a decade. That's nice to be able to say instead of 8 or 7 years or something like that. And for those who don't know, Fast Markets is a price reporting agency in the commodity space. So we report, that's kind of our bread and butter business is price reporting in anything from metals to grains to forest products. So I've worked on our kind of legacy forest products team on the analytics side, which is sort of separate from the price reporting side for a while now. And I've kind of helped cover different parts of the forest product space, pulp and paper, the packaging space. But again, my latest focus is on softwood lumber. So,
right. For those that don't know, flatbed spot rate prices, single family permits, single family housing starts all correlate positively, very strongly with the housing market. So we'll talk about that a little bit later. Dustin, we'll bring you back in once I go through the market update section. I'll go through that quickly. Chad will talk about the contract freight market, and then we'll dive into your segment. All right, let's start off with our market update today. Spot rates down sub-seasonally. Normally we'd see a little bit more movement across the board here, but reefer rates not showing the sort of movement we'd normally see 2 weeks out from July 4. Produce season normally starts to deliver pretty good volumes, but it's really tossing up too little too late for reefer carriers. A recent KPMG report found people are not just pulling back on spending, they're recalibrating. They're seeing a more selective and cost-conscious summer travel season. Vacations are still in budget. They report, though, but nearly everything else is on the chopping block. So that sort of leads into some of the lower numbers we're seeing in the produce season and lower volumes coming out of California that we'll talk about later. Jason Miller's truckload ton-mile index for April came out last week. Saw a 1.6% year-over-year increase, largely fueled, of course, by several factors, tariff-related, chemicals, wood products, machinery, wholesaling, all saw pretty good lifts in April. Residential construction that we're going to talk a lot about with Dustin plummeted to a 5-year low as buyers stay on the sideline. We're going to talk about single-family housing starts and permits. They're the most freight-intensive. But talk about the general macroeconomics surrounding residential construction. For those new to the show, this will lead into what we're thinking could happen in flatbed the rest of the year. Of course, interest rates held steady last week. The economy is basically sheltering in place. The Fed came out last week and said we're going to keep interest rates the same as what they are in the current range of 4.25 to 4.5. But basically a wait-and-see approach is being taken by the Fed right now. And Dustin's going to talk a lot about that a little bit later. Of course, the Iran-Israel war is of major concern. We're watching oil prices this morning. They're down on lesser fears that the Strait of Hormuz will be attacked. The downside risk is fairly evident there. There's not a lot of incentive. We've got a lot of global supply of crude. Demand is down. OPEC is increasing production. So if you had to say what was the best time to do this, it would be now, because the impact on global crude prices would be the least of any point in time. So, but nothing's impossible. We're watching a couple of vessels U-turned on Sunday once news came out that the US had bombed Iran. Those 2 million barrel crude tankers U-turned and headed back into the Persian Gulf. This morning, when I looked on the AIS tracker, they'd both returned to passage into the Gulf of Oman. They were heading back to load. So that gave a signal to the oil markets that there was a lower risk of the strait being attacked. The straits are not in international waters. I think Oman controls part of it and Iran controls the other part. So it's the global choke point for crude. Any impact there will be felt globally. And of course, at diesel pumps here in the US eventually. With that, our market update is out tonight. Go to dat.com/market update, where we're looking in depth at a couple of factors that we'll cover shortly, including load post volumes, down 2% last week due to June 19th. This year, the holiday fell on a Thursday, potentially creating a 4-day weekend for many, unlike last year where it was on a Wednesday and it was more of a split decision about whether people have an extended break. Load to truck ratio ended the week at 5.34. In the refrigerated market, the load posts, bit of a surge last week in outbound volume out of California, though it wasn't enough to lift the national market. As you know, a lot of refrigerated produce, time-sensitive, farm loading, so single point delivery. So a lot of it moves on the spot market. Load posts are up about 3%, boosted by some of that produce volume surge. Less than 2 weeks out from July 4, load to truck ratio ended the week at 9.48. And in flatbed, volume decreased last week. Typical seasonal adjustment. Volumes are about 15% higher than last year, though. Load to truck ratio ended the week at 24.44. Having a look at our 3 key indices in the dry van spot market, national rates ended the week at $1.67, down a penny per mile, following 3 weeks of relative stability. This rate mirrors the same period last year. It's about 1 cent a mile per higher than 2023, which is the black line there on the chart. Top 50 lanes based on volume averaged $1.99 last week, down 3 cents, about 32 cents a mile higher than the 7-day rolling average. And in our 13 key Midwest states, they represent about 45% of our national load volume. They're often indicative of national trends. Rates down 2 cents a mile in the Midwest. That drop occurred despite a 1% rise in outbound volume. The average rate in the Midwest was $1.85 per mile. Remember, that's excluding fuel. That was about 18 cents a mile higher than the national 7-day rolling average. In the refrigerated market, unlike typical years where the reefer market heats up 2 weeks before Independence Day due to increased shipping, this year, very different story. Last week, the national average reefer spot rate unexpectedly dropped 2 cents a mile, landing at just over $1.95. That's 6 cents a mile lower than last year. Despite an anticipated surge in spot market volumes over the next 2 weeks, it will be most likely be insufficient, even if rates go up, to trigger the usual spike that we see on July 4, as we reported last week, more like a speed bump this year. And in the flatbed market, the national average rate, excluding fuel, saw a 4 cent per mile decrease, settling at $2.13 a mile. That's about 9 cents a mile higher than the same week last year. However, as we all know, spot rates are about to experience their seasonal decline, which typically occurs from now until August before they start taking off again over the winter. Again, fairly seasonal activity in spot rates. Let's have a look at our short term. These are the short-term forecasts out 35 days using our flagship RateCast product, which is in green. It's going to predict what rate view will be 35 days out. Of course, it more heavily weights long-term seasonal trends. The forecast is bounded by the upper and lower forward-looking error bands in yellow and red. And of course, the blue line is the rolling 7-day weighted average of historical rates for actual loads moved over 550 miles. So really, excluding fuel, it's a real line haul forecast. Let's start with dry van. RateCast expects rates up 2 cents a mile out to July, I think it's out to July 26, thereabouts, that the 35-day ends. Rates they expect to be out at $1.68 by the time we get to the end of July. That'll be about 6 cents a mile higher than last year, up a penny through 7.4, so basically flat through July 4. The low case is expecting rates down 3, high case up 6 by July 26. In the refrigerated market, by the time we get to the 3rd week of July into the 4th week, rates are expected to be down a penny per mile to $1.95. That'll be about 5 cents a mile higher than where they were last year at the same time frame. On the chart there, the yellow high case is expecting rates up 2 cents, up 6 cents, high case up 4 cents a mile, or down 4 cents a mile as the case is there. In flatbed, RateCast is expecting rates down 3 cents a mile out to July 26, ending at about 209. At 209, they'll be 13 cents a mile higher than where they last year. So some above seasonal activity right there in the flatbed market. Low case has rates down 8, high case up 2. but that should continue to slide through the end of August, that green line. Again, no surprise there. That's following very strong seasonal patterns. But as you can see there across all three models, the July 4 spike that we'd be accustomed to in most freight seasons, the last three have been fairly muted as produce season has declined successively since about 2022. So I think that's a big part of why we're seeing less demand in the produce market and less of an impact from July 4 on dry van and reefer rates. All right, so that's the spot market. Over to Chad to have a look at the contract market.
Yep. Thanks, Dean. As a reminder, everything Dean goes over is from a broker to carrier spot perspective, and I'll cover relationships between spot and contract rates from a shipper perspective. So the spot premium ratio here for dry van rates in yellow goes back to 2016. You can see that spot rates are still below 11% below contract rates right now. So that spot premium ratio is measuring the difference between spot rates and contract rates. Negative meaning spot rates lower than contract rates. So we still have that depressed situation there. And the new rate differential answers the question, what are shippers' RFPs or bids on contract rates yielding right now? Most recent data point we have is basically flat at negative 0.5%. One of the first negative readings we've had in many months, certainly year to date there, looking at the data. And then on contract rate index, this is all contract rates. This is about 80% of our data that's just reoccurring contract rates. You can see very flat, slightly up trend. Last we looked at the year over year inflation metrics for shippers, we were about 1% up year over year. Moving on to reefer, you can see we're still at negative 9% on spot premium ratio, still quite low, and new rate differential at 1.9%, and contract rate index still pretty flat there for over 2.5 years. And then finally, rate per mile for dry van and reefer, the top two. So you can see that relationship between spot and contract rates, and we put in the flatbed relationship there as well. A lot more variability there, and those spot rates not yet coming up above the contract rates since the down market. So that's where we're at on contract rates. Dean, back to you.
Yeah, market continues to move sideways here as demand sort of disappears into the horizon. Great time to bring Dustin back in, talking about some of the big drivers of flatbed and dry van demand, which is, of course, residential construction. Dustin, what's the state of the domestic housing market?
Yeah, we're in kind of a tough situation right now with residential construction. I mean, we're starting to use the term stagflationary more and more right now, right? And I think it's this kind of double kind of this dual sort of headwind between obviously elevated interest rates that we're seeing in the market right now, right, which is really keeping demand at bay, probably more so in the resale market than the new construction market. You know, we're really seeing some of the bad data on the resale side. But, you know, 7% mortgage rates where we're hovering around has really kind of kept the demand side in check. And then certainly now we have kind of the consequences of the trade war, right, between all the, Section 232 or reciprocal tariffs that have gone into place on key construction items, whether it be, steel and aluminum or all the products that we import from China, which, even despite kind of some of the wind down of the most serious tariff levels we had early on here, if we're still talking about all in 50% tariffs on China, really that's just kind of a punch directly in the nose to the construction market, right? So that is where I think home builders, especially in the single family side, are getting anxious. They're entering their kind of planning cycles for next year. And we're getting concerned that, there's going to be more of a sustained pullback here in the market, which obviously for what we cover in wood products, we're saying that in a very real way in terms of product volumes entering the year here. So,
yeah, Dustin, before we sort of dive into some of those key points you made, just define stagflation for those that aren't completely au fait with the term.
Yeah, I mean, usually when we refer to this in economics, it's a situation where you're not seeing actual volume growth, right? It's kind of flat or declining sort of trajectory of volume, but you have increasing costs, right? So. You have the supply side being pinched here. You think about your basic economics, the supply curve shifting up or your cost structure shifting up, and really no demand pull to kind of, to really lead those volumes higher. So that's what we're seeing right now in the shelter market.
Yeah. Dustin, what is the Sorry, Dean. Dustin, what is that mix between imports and domestic production of lumber? How does the supply side work?
Yeah, great question. So, for softwood lumber, around somewhere around a third of domestic consumption in the U.S. comes from abroad. Most of that comes from Canada. So Canada accounts for about 25 to say 27% of softwood lumber consumption. That was higher going back 5-10 years when Canada's capacity base was much higher. Won't go too much into that, but that industry, particularly in Western Canada, has been in secular decline due to fiber availability, saw timber availability, and then we get a small amount from other offshore supplying countries like, for example, Europe, and to a lesser extent, Latin America. So the good news, like from the trade war perspective, most of the onerous tariffs on Canada have been sort of exempted, that are obviously in compliance with USMCA, which softwood lumber and other wood products are in compliance. The bad news is lumber already has duties from a separate line of sort of trade law that have been in place for some time now. And so even for the Canadian supply, those duties are set to go up based on the mechanical process that undertakes later this year. So even though Canadian supply is sort of been exempted for now, if you will, from the tariffs that have been announced so far, there's still higher costs coming for those important Canadian suppliers to the U.S. market.
What is the reaction time for U.S. domestic production to ramp, potentially to offset some of that?
A long time. Yeah. It's not, we actually wrote a viewpoint on this because it was this big question, right? With all these looming tariffs, what was going to happen? And obviously the Trump administration has been very vocal about, we have our own domestic resources here for timber supply. Why don't we use them? Which, that is true, that, the U.S. is relatively abundant in timber, particularly softwood timber, which is used for residential construction. The problem is everything around the softwood timber, between the mill infrastructure, the staffing, trucking, loggers, like logging, that's an industry that, from a headcount perspective has been in secular decline. Some of that is due to mechanization, but some of that is people leaving the industry because it's just a very tough industry to work in, especially the last few years. So, even if we are able to kind of tap our domestic resources between getting over all the environmental hurdles, and a lot of that softwood timber, especially in the Pacific Northwest, is on state and federal lands, even if you can tap into that, you're not going to replace that, 25 to 30% of supply that comes from Canada. That would take, based on our analysis, at least a decade. And that's, probably under pretty optimistic conditions, I would say. Wow. So,
yeah.
Dustin, talk a bit more about fiber. You mentioned fiber a minute ago. What does that mean?
Fiber is basically the actual wood, the standing timber in the forest, right? So you'll hear in our industry, fiber is sort of lingo for, it's the, the cellulosic fibers that are in wood. And that can go to any use. It can go to, fiber, as we use it, can go to lumber. It can go to structural panels like OSB and plywood. It can go to pulp and paper production. So, when we think about the world markets for fiber, the U.S. has a relative abundance because we have a lot of trees, right? And we, particularly in the South, we have, southern yellow pine is a very fast growing species. So it's not only the abundance, the abundance is a function of, sort of the climate, and also the speed that certain species grow. And particularly in the South, you have, southern yellow pine is very fast growing. So the U.S. has the wood fiber available to meet its needs for those applications, but it's all the existing infrastructure around that, which, as doesn't happen overnight. Oh, by the way, who's investing in machinery and infrastructure when tariffs are going up, right? A lot of those are being sidelined.
I recall last time you were on, we talked about the storage ability of different species. And I think there was a definite difference between Canadian lumber and US produced lumber. Can you talk a little bit about why that's the case?
Absolutely. And it's very relevant for the freight markets, right? So, traditionally speaking, when you think of framing a house, those sort of what I'll call the Canadian or Western species of lumber. So your Douglas firs, your hem firs. In Canada, the most prolific species is it's an acronym SPF, so spruce pine fir. It's kind of a mix of specific species of timber that have similar properties and attributes from a framing perspective. So when you talk about those are more stable, they have more stable wood properties. So meaning they're less susceptible to sort of wane and bow and twist, especially when they move through, say, a low or high humidity zone to an opposite zone, right? So wood is like a sponge. It absorbs and releases moisture. And especially, a Douglas fir has very closed cell walls. So there's not as much of that releasing and accepting of moisture. Southern yellow pine, which is produced in the U.S. South, is more sponge-like. It has more open cell walls. And what's happening, there's been an ongoing trend to shifting to the U.S. South for lumber production because it's lower cost. It's a faster growing species. It's more prolific. It's on private timberlands. It's not on sort of state and federal lands where we've drastically reduced harvesting. It's similar scenario in Canada where, it's all on crown timberland, which is basically provincial or federal lands. So there's been this pivot to the U.S. South. The challenge is that Southern yellow pine does not store well in a yard scenario. It's not going to sit for months like an SPF or a Douglas fir. So the whole model of shipping to the market has to change. It's really more of a truck market. So that's probably good just in relative terms for the flatbed market. Some of that also just has to do with geography, right? That Southern yellow pine is just closer to the end use market, the U.S. South, right? Exactly. So it's but it does face challenges because it does not yard well. So it's not going to sit for 6 months like an SPF or a Doug fir. So that's changing the whole model of shipping and distribution as there's more of the shipment of lumber production to the U.S. South.
Yeah, it's having a big impact on flatbed volumes, particularly our Quebec and Pacific Maritimes carriers that bring a lot of that lumber out of the Northeast. You can include all the carriers that run out of Maine. Because normally I-95, 495 through where I live, it's just, one after the other of flatbeds hauling lumber, and then of course running empty back because there's not a lot of freight heading back from, because you've got to cross the border with a load, of course, with cabotage rules. Yeah. Very interesting, fascinating. Talk a little bit about the remodeling part, what you see the split there. I haven't been following Lowe's and Home Depot earnings calls, but they must be seeing some sort of an impact on their side, right?
Yeah, I mean, the big box stores like Home Depot, Lowe's that are kind of, everyone sort of follows in the home improvement space, they're still facing a pretty challenging environment, right? Their volumes are pretty flat, and they're also kind of facing the supply chain and logistical challenges from this, sort of ongoing trade war, right? So they are still seeing some weakness there. We would say, and I guess just a little bit of context for some of your viewers, we often spend a lot of time on new residential construction in the wood products and the building material space because there's just so much more data out there on that space between housing starts, new home sales. Repair and remodeling, though, is really, depending on how you count it, is anywhere between 35 to 40% of total residential construction activity. So it's this huge space that we spend very little time on. Right. We have our own proprietary indicator for repair and remodeling, which tracks the volume of activity. And based on that methodology, we actually think it's coming off a low base, but we think it's actually reaccelerating. So we're still below kind of the pre-pandemic kind of trend line if you drew that. But we do think that there's kind of some signs of life there, certainly, but there's a lot of cross currents there between, obviously high interest rates affect repair and remodeling as well. The trade war with kind of concerns there and a slowing job market also is having an impact. But on the other hand, there's so much deferred activity in that space where people have been putting things off. And just similar to the broader shelter market, we are so underbuilt and housing is so unaffordable. A lot of people are finding that the path of least resistance to enhance and expand their shelter footprint is on their existing home, right? And I think that is kind of starting to come to a boil, especially as people have so much home equity built up in their homes. So Now not many are tapping it because of how high interest rates are, but some I think are probably throwing in the towel and saying, this is cheaper than me than buying a trade up and having to remodel that, or just given I don't want to leave my 3.5% mortgage rate.
Right.
I'm going to stay in this home. So that is, it's coming off a low base. We do think it's reaccelerating, but again, it's probably not enough to counter what the weakness that we're seeing in the new market right now.
Right.
Justin, what do you see the levers that need to be pulled to pull us out of this? How much of it is it tariffs settling out and interest rates? What needs to happen to pull us out of this?
Yeah, I mean, I think, as tough as the tariffs are on builders, and it's certainly, I think, creating this huge level of uncertainty, right? Which may, I think is going to make them be a little bit more conservative with their approach looking into next year, with construction activity. I think it's still a rate story in the end, because if you get mortgage rates coming down to 5.5%, 6%, that cures a lot of the tariff-led and sort of input cost inflation that builders potentially face. And the thing is despite a lot of the kind of the red flags, yellow and red flags out there in the construction market, builder margins, especially for public home builders, it's a different story for private builders, because they're subject more to the rate market as opposed to kind of the mortgage finance operations the public builders have, and the more levers they have to pull to clear the market. But at least for the public builders, most of their margins are still in relatively healthy territory. Now there's a variance there. There's some that are struggling more than others, but generally speaking, they have managed their situations pretty well. They have pretty clean balance sheets. So I do think if we can get demand moving, that will allow them to kind of have a more stable situation and maybe be able to pass on a little bit more of those costs from tariffs, to the consumer. And, that gets bundled in a 30-year mortgage and amortized. So some of those costs don't look as bad on a monthly payment basis, right? Mm-hmm. So that to us is still the big thing that needs to change. I think the last thing I'll say is we were entering the year, we were optimistic that mortgage rates were going to come down, just because inflation we felt was going to be pretty close to the Fed's target. Inflation is at and even arguably below the Fed's target now. The problem is the long end of the bond market, the 10-year, which the mortgage rates track, hasn't really come down because of concerns about now deficit concerns with this new tax bill going through. Is it going to explode the deficit and sort of crowd out private investment and keep rates higher, and maybe drive a reacceleration in inflation again over the long term? So that between that and just general kind of uncertainty surrounding the trade war and policy has probably kept rates higher than we expected. We think there's a potential for cooling in that back half of the year, but there's still a lot of uncertainty there given how chaotic the policy situation has been. It's hard to make that forecast for sure.
On the issue of policy, any impact of forced deportations in the construction industry that you're aware of?
So there's obviously been a ton of reporting on this, right? When you listen to kind of home builder calls and whatnot, you don't tend to see it quite as much in terms of being reported as an impact. So I think it's too early to say. We're kind of too early in the process. I think to us, our team, when we talk about this, I think we're more concerned about, rather than the actual deportations, than the actual deterrence effect, people not showing up to job sites. Right. Obviously we have less border crossings, which, without getting too much into the politics of it, certainly, the Trump administration is achieving its objective of lowering those border crossings, but that is having an impact on the labor supply pool. Between that, and again, going back to people who are in the country already, legal or not legal, not showing up to job sites, like that does seem like it is anecdotally having an impact. And again, it's another headwind for builders as they consider, are we going to build more units that are lower margin, or will we build less units that are higher margin? And sort of, they almost always tend to defer to the latter when things are looking tougher, and that's a way to kind of rationalize, a more fixed sort of labor supply, right? So,
yeah. I was just looking for some data. I did read a report last week from Coca-Cola and some of the large beverage companies reporting sales down, specifically because they target a lot of the minority communities. So there's actually some anecdotal evidence as well as some pretty hard data. Yeah.
Yeah.
Dustin, that kind of brings us up to the end of the show. Anything else you want to talk about that's you think relevant to the truckload sector and as it relates to housing?
I would just say, as it goes to the trade war, right? I touched on this with the lumber duties. Like, there's going to be a big shift in the market in the second half of the year. So, if you are, your business is tied to the Canadian sort of supply chain, we are going to see, because of the rising duties from the Department of Commerce, they're going to basically double for Canadian producers in the second half of the year. That is going to drive a lot of curtailments in the Canadian market. And then, I didn't mention this on top of that. There's also a Section 232 investigation into wood products as well that is still ongoing, that in theory could stack on top of those duties, which would be like a, borderline apocalyptic event for the Canadian industry, right? So, so I think the long story short here, we're going to see a lot of shipments, whether they come via rail, a lot of rail car shipments come from Canada, but certainly flatbed as well, shifting to, the domestic market here as we see domestic, sawmills, their operating rates jump up. So that probably, net will boost the flatbed market to some degree. But certainly by geography and by, sort of supply lane, there's going to be some big shifts in the second half of the year into early 2026.
Yeah, and of course, as we get into winter, that's when sawmills start to boost production to fill all of the inventories over the winter months. So we'll have to watch that very carefully. It's been a fascinating discussion. Chad, anything else you wanted to fire at Dustin before we go?
No, this has been great. Well, yeah, let me think about that. So if you had to call it, when does the housing market start to pick back up? We get this question on the trucking market. We've been calling a trucking market rebound for 2 years now, Dean?
At least.
We're waiting for it. So Dustin, if pressed, when do you call a turnaround?
Yeah, I mean, we've probably shaded too much on the optimistic side ourselves here as well. I think probably similar time frame last year or two, maybe a little more. We felt like there was going to be a recovery again based on this rate story. So we do have a housing, recovery next year, in 2026, predicated on, a cooling in the rate environment, and also at least some sort of softening of the policy, sort of uncertainty that's driving things. So that is our baseline. But I mean, I think we would, especially, we always put the caveat that no one knows the future, and forecasting is dangerous business in of itself. And I think it's even more so, as you guys know right now, just given all the policy levers at play. So, optimistic recovery next year, but, we're going to put an asterisk on that one, I think. So,
all right. Pretty safe call.
We talk about headwinds and tailwinds. You've added cross currents to the mix today.
Yeah, I like that.
There you go.
I think cross currents are very apt for what we're facing. All right, Dustin, how can people get in contact with you if they want to learn more about fast markets and the building industry?
Yeah, you can always reach out to me. My email is djalbert at fastmarkets.com. So that's djalbert at fastmarkets.com. So you can contact me if you have any questions or want to learn more about our offerings or any questions you have about the wood products markets.
Yeah, fantastic. I've learned a lot today. Thank you for being on the show. A couple of call outs. Don't forget the ACT Research Conference is coming up August 20. Go to actresearch.net. Of course, Radio Nemo's studio grand opening is on July 23 in New Orleans. You can catch Road Gang Radio every day at 7 a.m. Central. iHeartRadio, Facebook Live, YouTube Live. I'm on there every second week and on other occasions during the course of the week, 7 a.m. to 11 Central. Journal of Commerce Inland Conference, not far away, September 29. Make sure you put that in your calendar. Chris Kaplis is talking to Mike Hicks from Ball State University. It's out this Thursday on the Freight Vine podcast. Next week, a great guest, owner-operator truck driver Aubrey O'Meara is on. She's somewhat of a social media sensation. I met her in March at the Mid-America Truck Show. Great guest. Looking forward to talking to her about women in trucking. Make sure you set up alerts to our live shows. Subscribe to our channel today. And with that, another show is in the books. Thanks for watching. Be safe. Be nice to everyone. We'll see you back here again next week at 10 a.m. Eastern, 7 a.m. Pacific.